This is Beyond the Resume, the podcast that brings you the stories, advice, and insights behind some of the most successful people in real estate. Beyond the Resume is brought to you by Jackson Lucas Executive Search, the industry leader in human capital solutions. Here is Chris Papa and Lisa Flicker.
Welcome to the webinar. This is the Natural Occurring Affordable Housing webinar. And it's Chris and Chris's first one together. Shockingly. My name's Chris Papa. Actually, Chris and I met, we were at the ULI Affordable Housing National Council. That's how we met, I think. Yeah. And
Yeah, I think so.
And so I'm the founding partner of Jackson Lucas. We do executive search and real estate organizational consulting, and we have a national presence of about 50 people. I've been doing a ton of work in the affordable world, affordable housing, workforce housing world for most of my career. So it's my niche, my interest. And then I met Chris, and I guess, hey, you want to introduce yourself, Chris?
I'm Kristen Niver. I'm a commercial real estate attorney with the law firm of Robinson Cole. I've focused on affordable housing my entire career. Before I became a lawyer, I was an urban planner with a focus on affordable housing, and I went to law school with a specific focus on affordable housing. I primarily represent lenders, but I also do some development work, and I'm very excited to be here for this conversation. So, why don't I just kick it over to the panelists to introduce themselves? I don't know who wants to go first. Maybe Dylan?
Sure. Hey, everybody. I work at AEW. I've been here for about 4.5 years. I joined to launch a strategy focused on housing for moderate and lower income households. And for those of you who don't know, AEW, we're a global investment management firm that focuses exclusively on real estate. We're about 80 billion in assets globally, and about a quarter of that is in housing.
So glad you're here. And Ty, do you want to introduce yourself?
Absolutely. Good afternoon, everybody. Ty Barnes. I work as head of investments for Community Dad Partners, which is a vertically integrated owner-operator based out of Austin, Texas. I live in New Jersey, and what we do is focus on workforce housing. So we're one trick pony in that space. And what we do, I think our special sauce within the industry is that we also focus on resident engagement and enhancing the lives of our residents. So we provide a lot of services like telehealth, English as a second language, food pantries, job training for our residents, so that we could be a real part of the community. And I'm excited to be part of this discussion today. So thanks for having me.
All right. Yeah, Lily?
Yeah, hi, I'm Lily Goldstein. I'm Vice President of Portfolio Management for Leo Impact Capital. We are a subsidiary of JBG Smith, a Bethesda-based REIT that owns, develops, operates, and invests in primarily mixed-use investments in and around the DC metro area. And Leo Impact Capital is our impact investment management platform. So we have a little over 3,000 units in our portfolio, and we focus on the preservation and creation of workforce affordable housing. So really targeting missing middle renters, renters by necessity, by investing in operating and preserving affordable housing. And thanks so much for having me today.
Yeah, and just a heads up for those expecting AJ. We really wanted Lily, but AJ assisted. Then at the last second, so Lily.
Yeah, thank you, Lily.
Yeah, my pleasure. And just for context, AJ is the president of Leo Impact Capital, so he leads this platform. And I focus on sort of all things portfolio management, investor relations, and public policy.
And you've also worked closely with him for a very long time. Is that
Very
right?
long.
Yes. So
Yeah. Not too long, but yeah,
yes.
for like 7 years now.
7 years, that's a long time. Yes.
Yeah.
Great. So thank you. And last but not least, Alicia?
Thanks, Kristen. Alicia Hill, I'm Vice President at FCP. I work on our housing preservation strategy. So FCP We're based in the DC area. We invest nationally in the workforce and affordable housing space. We own around 30,000 units today and have been doing that work for the last 25 years. Similar to my peers and friends and colleagues here in the industry, we care a lot about resident engagement and resident services. So that's a part of the work that we do as well. And we invest across the spectrum of naturally occurring affordable housing, as well as some regulated housing, and then also more conventional value add workforce product. Thank you guys for having this conversation and really excited to be a part of it.
Thank you. And just a heads up for those attendees, feel free to, at the end, we're going to answer your questions. So put them in the chat. I think Zoe, who runs operations here, will be helping us with that. But put them in the chat and we'll try to get to them in the last 10, 15 minutes or so.
Great. Yeah, so I think we're going to kick it off by just sort of talking broadly about what NOAA is. And I wanted to turn it over to Ty or to anyone else to just kind of broadly kind of run through what NOAA is, how it differs from capital A affordable, and what some of the typical characteristics are.
Sure.
I don't know if anyone wants to kind of kick it off in that way.
Happy to get it started, but then I'm sure everyone else can jump in as well. So there's no universal definition for NOAA, or naturally occurring affordable housing, but generally we talk about AMI ranges. So AMIs being between 60 and 120% AMI. Now, in non-coastal markets, to give you some reference for rents, that means that the NOAA product is usually about $300 to $1,000 cheaper than the newer build Class A product that's delivered in the last couple of years. And the difference between NOAA and capital A affordable, at least the way that I think and wrap my head around it, is that there are no subsidies. So that means on the rent side, there are no subsidies. On the capital stack, there'd be no grants or loans from any government agencies. And then on the expense side, there are no real estate tax abatements. So it's market rate housing. It just tends to be a little bit older. So vintages of the 70s to 90s. Some of the other panelists might go older or newer than that, but that's kind of a general range. These are infill locations typically, and they're occupied by the workforce of America. So this is where our firemen, police officers, first responders, educators, retirees, a lot of those residents live in naturally occurring affordable housing. And it's usually 2 or 3 story, low density garden style product. And purchase prices today are about 10 to 15%, 10 to 30% below new build construction costs. So that's kind of a general framing of workforce housing.
Yeah, I was hoping Alicia or Dylan could kind of jump in about how affordability restrictions are then imposed on NOAA properties, if at all, and how it's determined what the tenants can afford to pay given the lack of regulation, or just more generally on kind of why invest in NOAA then, and how do you make it pencil?
Sure, I can start. So with respect to the target affordability ranges and how we determine what is affordable, essentially as an industry, we generally, I think most folks here probably, but certainly as an industry, if you think about the U.S. Department of Housing and Urban Development, ascribe to this concept of households having to pay no more than 30% of their gross income. So the thought being that affordability is a relative measure. So depending on your actual income level, you are cost burdened or overpaying more than you can afford, paying more than you can afford effectively, if more than 30% of the household income goes towards rent and living expenses. And so as an industry, and certainly in the context of FCP, we really look towards AMI from a geographic perspective. Every market has a different median income. We oftentimes will look at the MSA, or in some cases, depending on the program or the priority, we might look at county level to try to understand from a census perspective, data that you're getting from the American Community Survey, which functionally feeds into what HUD puts out every year. What is the AMI of a place? And then commensurate with that, what is the right level of rent that ties to a certain level of AMI? So for us, generally, we look at 80% of AMI and below. A lot of that is really governed by a focus on aligning with the Community Reinvestment Act, which essentially tries to really focus on low and moderate income households that historically, if you go back to the days of redlining, were excluded from thinking about investment in certain communities. So that's generally how we think about it overall. I think it's always an interesting question to consider, what does cost burden mean in a market and an environment that's experienced inflation and other factors over time. But as an industry, we generally ascribe to this idea of sort of this 30% threshold being within the realm of affordable. And once you're outside of that, then you start to see all of the effects of lack of affordability that we experience as an industry.
Yeah, do you want to talk more about how the affordability restrictions are imposed, or we could talk about that later, but that did come up in our prep call a little bit, just when there are deed restrictions or
Yeah, sure. I'll just say, so depends on the strategy. From a NOAA perspective, we really approach it from a sponsor initiated approach. So our really thesis around this work is that we have a mission imperative as an organization around our preservation work. So if there isn't an actual deed restriction requirement that comes with the property, which with NOAA, as Ty mentioned, that's not really a feature, then we essentially asset manage towards those goals. So we think about, okay, we want at least half of our overall portfolio to really prioritize folks that are 80% of AMI and below. I think the good news is that in many cases, when you're looking at NOAA product, because it is older in many cases, that's just sort of where market is. That's sort of the idea, is that the market affordable sort of rent level is in line with what the maximum willingness to pay a household would have for a product of that type, that age, and that location. But if that is not the case, we solve for that on our own by doing, a level of analysis to understand what the affordability is.
Dylan, how do you get that to pencil?
Well, these days, I mean, I think maybe the part of this that we haven't directly addressed is, because this is unregulated and unsubsidized, believing that we have an efficient market, the market is pricing the rent, the market is pricing the asset. It's easier today to get investments to pencil for the return objectives of, at least of the capital that we serve, because we've had this protracted period of market dislocation, right? I think we've Ty alluded to this in the beginning. We're using NOAA as a terminology to describe a segment of the market that has always existed. And the way that people have traditionally invested into this segment of the market has been through value add business plans. So buy something that's a little tired, scratch and dent, and put in new cabinets and countertops and charge 20% more rent per month and sell it when you've maximized your IRR. That isn't really, I don't think, the objective of the capital for anybody who's on this call. And given that we aren't trying to move rents and NOI as aggressively and quickly as we can, given the fact that it's much harder to access capital, both debt and equity right now, it's easier for us to be competitive in the market, and still preserve affordability at rents that are much closer to where the market is today.
Right. Yeah. I don't know if Lily or Ty wants to jump in, and kind of staying on the topic of supply and demand cycles. I'd like to talk about more like, why is NOAA needed and kind of where it fits in, and the importance of NOAA and why.
Yeah, happy to start on that one. I mean, I know that could be an hours-long conversation in and of itself. But, what we really see is, and why JBG Smith, as a market rate operator for 60 plus years, sort of got into this space, was we really saw a disconnect between the supply of and the demand for quality housing at reasonable rents. And it really becomes an economic driver of any given region. If you can't provide housing for everyone, particularly here in the DC region, we saw a really interesting phenomenon where we were growing at the high end of the income range or spectrum and growing at the lower end. But in the middle, we were actively losing residents because they couldn't afford housing here. And their jobs may or may not have been sort of more virtual or more flexible, and they were able to move to other more affordable regions. And so speaking to the demand, there's always going to be a group of essential workers. Obviously, that term has sort of changed over recent years, but they're folks that I sort of describe as making our everyday run. The teachers, nurses, firefighters, transit operators, administrative professionals, etc., that are sort of going to be renters by necessity. So folks who are really priced out of home ownership opportunities. And also aren't really necessarily well served by the market. So there's sort of always going to be that imbalance. And then on the supply side, there's an abundance of aging properties. Some are best suited for complete redevelopment, but others have been maintained pretty well over the decades. We look at, Ty mentioned sort of 70s to 90s. In the DC region, we look back all the way to like the 40s and sometimes even earlier, but also even newer. We have a couple of assets in our portfolio that were built in the 2000s, and it really just sort of depends on the location and sort of the circumstances that make it affordable. But there is an abundance of opportunities, and a lot of folks think that affordable housing is solved for by the low income housing tax credit program and what we consider capital A affordable, but it's really in this NOAA supply. But as we've discussed, it's unregulated. And so in order to ensure that it's staying affordable, that it's sort of committed to this affordability, isn't going through a value add repositioning where rents are increased beyond that sort of rent burden level that Alicia mentioned for 80% and below residents, there's sort of an abundance there of investment opportunities.
If I can piggyback on that too, I think one of the big things in our space is that there are totally legitimate legal business plans where people take naturally occurring assets and, to Dylan's point earlier, they do some value add and actually take call it a B minus asset or a B asset and move it up one or two steps in that ladder. That reduces the availability or the supply in these markets for the critical workers that Lily just mentioned. So the people that we need to run our cities, and I think you said to make everyone and make the cities thrive, they don't have a place to live or they get priced out. And then what ends up happening is they end up having to relocate to another city because it's a lower cost of living. So then you're losing your educators, you're losing your first responders, you're losing your municipal workers to other places because of cost of living. And once that starts happening in some of these towns and cities, like it can really happen quite more quickly. So I know there are some smart municipalities that are trying to get ahead of this, especially with some of the migration patterns that were accelerated during COVID. So we're all trying to play catch up, but like the need for our product is only increasing and the supply is decreasing.
Has there been was capital asking for this, and like what type of capital is patient enough to do this?
So I'll jump in here. I think it depends on how you view the risk profile, right? So, to the points that have been raised, there are different approaches to working with this type of product. And so historically, capital may have seen this opportunity through a value add lens. But what's really compelling, particularly now that there's more and more data, is that you've got really good information that properties that skew from a rent level perspective, more in this range that we're talking about, call it the 60 to 100% AMI, that over a 20 plus year period, they have lower rates of volatility because there's higher retention, and we view that as more demand. They also have pretty consistent, stable return over time. Now, there may be years where you have some ups and downs because we have a cyclical business, but there is a secular nature to the demand for this housing. And so I think, to your question, Chris, I think it's the capital starts to appreciate, from what I've seen, a few perspectives. One, that affordability is becoming a risk if you ignore it. So regardless of whether or not you can be agnostic and just a multifamily investor, if you're not thinking about affordability in your markets as you really pursue opportunities, that's a potential risk area. I think we've all seen the cautionary tales of, what's happened in some markets where bad debt gets really blown out because there's a lot of upward pressure on rents over a relatively short amount of time in places that experience a lot of in-migration. Or you also may see that there's an accretive opportunity because cities, as Ty mentioned, do want to get ahead of this. So they are potentially really prioritizing certain incentives if it's a NOAA opportunity and finding ways to try to help sponsors continue with a preservation plan. In some cases, there also may be instances where you may find other owner-operators, particularly with the LIHTC program hitting its first 30-year benchmark a few years ago. There may be some assets that are exiting that program where there's an initiative to try and continue to preserve similar levels of affordability at some of those original assets that came through more of a capital A approach and the origination side. So I think it's really a risk profile question. We see different lenses. We see some that are really looking at this more as value add, and then we also see some that really buy off on a core plus, more stable, consistent, not as much high growth, but for the long term, accretive business.
Yeah, I think so I used to work as a consultant advising institutional capital, and over that period of time, what I observed is that there are a lot of really high quality sponsors investing in this segment of the market with closed end commingled funds and value add business plans. There was really no one investing in this segment of the market with that risk attenuated view that Alicia just described. And I think we've all been on a journey of education over the last, say, 5 to 7 years, talking to different pools of investors about the merits of having a more preservation or income oriented approach to this segment of the market as a complement to those other segments, right? There's nothing wrong with having a tactical sleeve for residential housing in your portfolio. It can be great if you time the market right and you have a good sponsor and good execution. But it's also good to have something that looks and feels more like an inflation adjusting bond to complement that. And I think this segment of the market really enhances an overall portfolio return if it's complementing those other strategies.
Yeah, and I just add, the capital is required to be patient, but a lot of the folks investing in this space are really focused on that long-term affordability. So it's sort of a natural complement to being patient capital. We have seen there is friction between getting a return of capital, but also maintaining long-term affordability. We've personally written some flexibility into our governing documents to allow for that longer-term affordability focus. But traditionally, a lot of these investments have been made through sort of the similar pool of investors in the low-income housing tax credit program. So banks seeking CRA credit, as Alicia mentioned. But sort of similar to how there's no one definition of NOAA, you ask 5 impact investors what impact investing means, and you'd get 6 opinions. And whether or not they agree on, is there a discount to market? If there is, what is that discount in exchange for doing good? And really what we've come across and have been most successful in having conversations about is really what Alicia mentioned, and that focus on it's a risk adjusted return. These are cash producing stabilized properties. Sort of the value add component that we think about is not the physical value add through renovation, whether light or heavier touch, but really value add through management and through ensuring that our residents are our primary focus, that they are well housed, quality housing, stable housing, affordable housing, et cetera. And being able to achieve that sort of core plus return just through operating really well performing stabilized properties. And that's really where we've been successful with sort of the more traditional impact investors. If they're looking for, a 30+% return, we're just simply not going to be the right kind of investment for them. But if folks are just looking for, as Dylan mentioned, essentially like a bond-like investment, this is a really good place to be focusing.
And two, on that point, and I think asking a question to everyone else too, is that, I think for the last couple of years, our markets have probably gotten a little more crowded as people were searching for that bond yield type coupon, especially when interest rates were super low. Once they started shooting up again, I think that we were actually competing with bonds. But I feel like going for, pre-COVID, a lot of people were coming into the workforce housing space because they were trying to get what used to be the old bond type coupon and the durability of those cash flows and the stability of it. If rates start going down, I actually think that's a good thing for our business, because the durability of our performance, to what Alicia and Dylan mentioned before, and Lily as well, I think then we get more attractive to some as part of a portfolio construction.
I would agree with that, and I thought that was interesting for us, having capital partners who were really looking at this segment of the market as a fixed income substitute, right? They were transferring capital out of their fixed income portfolio into this segment of the market. I would say, though, during that period when capital was cheap and readily available, we were competing against folks on the investment side who had a very different appreciation for risk in their underwriting than we do. And it made it
Think about
very
that.
hard, Chris, to your earlier question, to make deals pencil. You had to get very creative um, to make the numbers make sense and still believe in them when you're competing against people who maybe are a little faster and looser with their assumptions than we collectively are.
Which is actually, I think, going to be interesting in these next couple of years, sort of piggybacking off of that. We're certainly seeing, particularly in the Southeast region, a lot of deals that came to market a couple of years ago were acquired with short-term debt, syndicated equity, and the banks and the equity investors are calling. And a lot of them, some of them are more traditional NOAA properties, but actually some of them are going to be new construction, but just sort of in areas where market rates are or market rents are sort of in that 80% AMI area, and could present a lot of really interesting, hopefully lucrative near-term opportunities to do some really good preservation of quality housing. So I think it'll be an interesting sort of 18 months of where things go.
I don't know if anyone wants to hit on any more challenges with NOAA. We've talked about some, and then any pros and cons of it being less regulated.
So I think, sorry, go ahead, Dylan.
I think
You start.
We all have challenges.
I could talk for hours about all the challenges. One of them, which I think is interesting, and we all, I think, spend a lot of time and energy on, is resident services. I think when you talk about NOAA, which is can be a very broad segment of the market, you're talking about households. Within our pool of assets, we have 30% AMI households, and we have folks that are earning 115% of area median income. It's a very broad range of financial capabilities. So figuring out exactly what the needs are and desires are for that resident population at a given asset, and then delivering those services in a way that they're receptive to them, I find to be really challenging. Like, we all talk about it. I think we all spend a lot of time working on it. And I also always, one of the things, I grew up in an affordable housing community, so I kind of take exception to people sitting in ivory towers telling someone how they should be living their life, when at the end of the day, like, I come home and I just want to watch Netflix. Like, I don't want to read a book about financial literacy. I know I should, but I don't. So who am I to tell people what they should be doing with their time and energy? But listening to them and understanding what it is they really want to spend their time doing is hard. And I think if we can do it well, it'll benefit everybody, but it is a challenge.
I would certainly agree with that. I mean, I think, something that we've learned is that resident services is really part of your asset management approach. It's not this outlier thing that sits on the side that you just offer. You do have to really be responsive to what residents want. And we work on it all the time. Tactically, we use survey capabilities. We also work with nonprofits and third parties where their core competency is really in being attuned to really figuring out what residents want from a programming standpoint. And if something's not working, then we don't offer that program any longer, and we try to get closer to understanding what would be interesting. But I think, to Dylan's point, being very thoughtful around what you're offering and what has real meaning for residents. So a lot of what we've done over the years is to partner with groups that can provide after school support for students. And that's one where, I think the fact that it's at the property where the students get let off the bus, where you've got sort of this intermediary nonprofit organization that really understands the community, can build a rapport that's not property management, but really is there to be, a facilitator of community engagement. And it's a service that has an additional benefit for the residents where it's offsetting, hopefully, some some level of cost because they don't pay for it by having it as part of the programming, that really is helpful. And sometimes we can use that as a node to deploy other offerings, whether it's wellness support or to have, financial education workshops or things like that. But I also agree, you can very often have programs in place and they don't get utilized. And so you have to really stay on top of, just like you would with a leasing strategy or a marketing strategy, you have to stay on top of what's really engaging folks and how to manage it. And frankly, how to continue to offer high quality services over time that are supported by the operations of the property. Because that's as important. We want it to be something that's available to residents that they're not paying for, but that really is part of our overall strategy to keep them in place and want them living at the property long term to increase retention.
And that's a part of it too, because I think a lot of it is that with home prices being so expensive, you know, one of the things we're talking about, these are people in our buildings that have really important jobs, but jobs that typically pay pretty well. But in places like DC or Jersey, where I am, and in other parts of the Sun Belt too, like it's just gotten really expensive to own homes, and there's not enough inventory to keep up. So people are staying renters for longer. I think what we're all kind of articulating is that there is a need for people to be part of a community. Our residents aren't transient residents. They're not there for 1 year and to move on. They do raise their families there. They want to be there for several years. So by offering the programs that we offer, we're integrating, residents into the community long term. We're introducing our programs there too. And everyone's not cookie cutter. There could be a program in a certain city where there's a high degree of manufacturing. Maybe we have some sort of training program at the property for people that want to develop some, maybe whether leadership skills or financial literacy. And there are others where English as a second language might be the right place. To have that flexibility too, and to be able to adapt to our tenants, I think is part of the double bottom line investing that we all try to achieve too.
Yeah, and I'd add, Ty, I think that's a huge point that we really focus on is sort of differentiating between our properties. For right now, our portfolio is focused on the DC metro area, and even within just this one metro region, we have very differing populations at each of our assets and our communities, and so want to make sure that there's sort of no single application. We have a partnership with an incredible organization called Azuzu, I'm sure many of you are familiar with, that help residents with their credit building. And so we do apply that at all of our communities. But when you sort of dive deeper, it's a real question. And so that really is a challenge for us, is making sure that we're not only partnering with the right organization, but the right organization at the right community, and making sure that we're really meeting residents where they are. And to Alicia's point, not spending a lot of money on programs that just aren't beneficial. And a lot of these are nonprofit services or are reasonably priced, so it allows us to operate them within our communities without passing the cost on to the residents, sort of through that retention benefit. It's sort of a cost that we get to avoid, that turnover cost that we get to avoid as a result. But it's a challenge that we're constantly addressing, and it's a newer space. As Dylan mentioned, 7 years ago when we started this, that how we talked about impact investing, the preservation of workforce housing, et cetera, has changed 100 times over. And so it's still a newer space, and there aren't a lot of programs or organizations that are focused on the sort of middle income renter. There are a lot of folks who are doing great things for obviously market rate communities, and a lot that are sort of focused on capital A affordable, but there's still sort of an empty space in the middle as it relates to resident programming. And so we're really trying to find the right ones for our communities.
I want to pile
Go ahead, Dylan. Go ahead.
on another challenge. So one of the things we haven't talked about, but Chris, your first question that I answered anyway was like how we remain competitive in the market when we're acquiring assets. And I think one thing that all of us do, I think, is public-private partnerships. So collaborating with local municipalities for various types of financial incentives in exchange for lowering and constraining future rent growth. And the thresholds at which rents tend to get constrained are 60 and 80% of area median income. As this is kind of an emerging segment of the market, having constrained rents in lower barrier to entry markets at 80% AMI, I think one of the challenges is having a kind of industry ecosystem focused on, and we were talking about resident services, serving those, say, 70, 80% area median income households, but also how do you income qualify them in an efficient way? Because these are not households who think of themselves as needing or necessarily wanting subsidized housing. And how do you then address this renter universe in a way that allows them to feel good about where they're living and why they're living there, and also is supporting them in ways that are relevant to their life? Because broadly, the property management and resident services universe has oriented towards, we're going to fix and flip this asset for this kind of price point, or at the lower income level, we're dealing with households who identify as wanting and needing affordable and wanting and needing a set of services that maybe those higher income households don't.
Dylan, I mean, we spend most of our day trying to answer that exact question as it relates to the income verification specifically. We do income verify all of our residents who are living in our affordable units, and we call our process sort of LIHTC light. For a lot of LIHTC residents, there's a huge benefit, and they are, to your point, sort of expecting, okay, I'm able to move into a new tax credit building, so in exchange, I'm going to have to give them 1,000,001 documents to prove my income. For us, a lot of times these folks have been living in these communities for a really long time, and then we come in and say, hey, do you want us to make sure that your rent is affordable, and not just today, but for the long term? We only raise our rents in line with income so that folks can plan and folks can sort of understand how their rent is going to be increased over time. And yes, there is usually a discount to market, but sometimes that's actually not necessarily true today, but is going to be true in the future as more development occurs around. And so that incentive is sort of a lot lighter than it is for tax credit buildings. And residents are just saying, like, nah, I'll just forgo that affordability. I've been dealing with it for however long I've already been living in this community. Yeah, you tell me my rent actually might go down if I provide this information, but I'm sort of just not interested in going through the hassle. And then sort of one really disheartening thing that we're seeing in one of our communities in Prince George's County is actually now a lot of folks are saying, I don't know what you're going to do with my information. And like, not to turn this into a political conversation, but they don't want this information being recorded and reported, and are actually just moving out of certain communities if they're asking for income verification. And so we're working with the county to say that's not right. And this is sort of a larger political conversation that we need to have, but these are the residents who should be living in these communities, and they shouldn't be scared to share their documentation. And so when we submitted our current fund for approval for with the OCC as a CRA qualified investment, we actually included our income verification process because it's such a huge part of the operational challenge that we face is just finding managers who understand how to income verify and residents who understand the benefit.
Yeah. And marketing to those residents is different, right? It's a very specific income range. And you have to treat them differently in our experience.
I'll just add, we've seen sort of similar themes, and I think it sort of points to a broader challenge on sort of the future of public-private partnerships, which is there's sometimes these unintended consequences that just come as part of putting a policy concept on its feet and in practice. And so, you can have instances where there are some places that are thinking about the future and they're thinking about that 100% AMI renter or that 120% AMI renter who really does fall within that essential workforce in those jurisdictions, but who, to the points that have been made, have never been asked to provide a lot of this information and don't self-identify as low income. And so I think, that is something that as we evolve as an industry, and we certainly do this when it shows up, is really doing exactly as Lily described, which is engaging community by community with the different stakeholders who have the opportunity to help provide some of these incentives and benefits, to help deals pencil, to help them understand what does it actually look like on the ground when you're actually trying to execute, and what are some of those considerations? I had not heard any examples, similar to what you described, Lily, with the information sharing, but I wouldn't be surprised to see that come up even more. We oftentimes will see, over income qualified leasing traffic, oftentimes in places where they're not high income per se, but based off of the box that's sort of prescribed for some of these partnerships, you're not able to capture some of the folks that you would like to, even though they would also benefit. So there's a number of just execution nuances that are hard to really understand until you actually try to put some of these frameworks in practice. And we need the public-private partnerships because that's really what's helping a lot of deals get across the finish line today.
Thanks. We have 17 minutes left here. So.
I was going to kick it over to some of the questions, which we have some good questions in our chat, and some of them connect to some of the questions I had not yet asked. Does that work for you, Chris? Or the first question is from an anonymous attendee. And that question is, what are the profiles of limited partners that are willing to accept this lower cost of capital in exchange for social or non-financial impact? And I wondered if any of the panelists, because I was having that same question. I guess I'm not sure, but yes, please answer.
Yeah, I'm happy to start. We're fundraising for a new fund, so I'm spending sort of every day living in this. I mentioned the most traditional sort of pool of LPs are going to be CRA motivated financial institutions. For them, it's a little bit of a black and white investment for them. If there's a CRA need in that particular market, then that becomes a lot easier of a conversation. On the flip side, if there isn't, then we'll probably catch you on the next CRA cycle. But outside of that, we're seeing just increased interest in foundations, endowments, and sort of related family offices, particularly as the sort of younger generation steps in. There is a renewed focus among millennials and Gen Z to really understand how their money is being spent and what social good is coming out of that. Certainly more so than some of the more traditional family offices that we've sort of seen in the past. And foundations are also getting more creative with sort of how they're structuring their investments, whether it's through program-related investments or sort of mission-related investments, and sort of understanding what's true to their corpus and what kind of return they can accept on those kinds of investments, because sort of understanding that there is a way to do good while also doing well.
I think it's a really broad range of investors. I think, in my observation, actually, the folks who identify as impact investors tend to want much higher returns. They want stable bottom line, but but not at the expense of a mid-teen to high-teen gross return. But if you think more around institutional capital that has core allocations and wants and needs something that is a kind of high to mid single digit return in their portfolio as a complement to everything else, I think they're actively interested in this space.
What is this is a question from Kenneth Pulcinelli. What's the expected hold period for these assets?
So I can start. So for us, we look at it on a long-term basis, which could be anywhere from 7 to 10 years. We really would like to hold these assets for as long as we can, provided that we think, they're ones worth having. And so it's a longer-term approach, but we generally look at 7 to 10 years.
Yeah, some of the I think Dylan said Cowboys, was it earlier? Some of the people that we were competing with earlier in the cycle, I think there were usually 2 or 3 year holders where they would buy property, do renovations to 100% of the units in 36 months, 24 months, and then try to get out as quick as they can because they had floating rate debt. We're usually 5 to 7 as well. Some people that have open-ended core plus funds, they might hold it a little bit longer, but you usually see it around 5 if you can responsibly do renovations and things of that nature over a 5-year hold period and still keep the rents within the guidelines we've spoken about.
I think for us, we have a minimum 10-year expectation, but the aspiration is that if we get it right, if we're picking the right asset in the right market, we're going to own these assets for decades. You know, the really attractive aspect of this part of the housing market is this protracted supply demand imbalance. And that housing community that I grew up in as a kid still has a wait list. So we're 5 decades in and we haven't figured it out. And we have an asset that has rents that grow in line with inflation, is 100% occupied. Like that's something that fits really well in a diversified portfolio. Um, I think hopefully investors appreciate that kind of durable, recession resilient return characteristic, and will have a long-term orientation when we can find those great assets.
Gotcha. Just a heads up, we're not going to get to everyone's questions here. There's a lot of them, unfortunately. But I would love if you could email me or Zoe. I think Zoe emailed most of you. Email the questions to her or me, and I will make sure I get them answered for you.
Yeah, I wanted to hit on a couple from Alexander Alamani. The first is about property tax abatements, and Alicia mentioned it briefly, but Maryland recently expanded their pilot opportunities for NOAA, although AJ Jackson sort of expressed that it has some limitations. But I wondered if any of the panelists could talk about NOAA properties that have property tax abatement, and Alex asks if it's a better business plan. And then he also asks what the agency lender perspective is on NOAA, and if there are any specificities from the agencies. And we had talked on our prep call about the role of agencies, so not sure if anyone has anything to say there, but
Yeah, so I guess on the tax abatement point, it's a great business plan where that opportunity exists. Generally speaking, the framework is that you are entering into some sort of agreement, which it requires a deed restriction that is governed by a local municipality. Kristen, you mentioned within the state of Maryland and their newer piece of legislation, but usually there's a deed restriction that sets aside certain amounts of units at certain affordability levels. They typically like to see some at 60% of AMI, some at 80% of AMI. I've seen them in some places as high as 120. There's usually a reporting requirement. There's usually some requirements around income and rent certification. Some of them are just based on rent levels. Some of them are income levels and rents. So it can be great because it can completely or partially eliminate your operating expense as it relates to property tax. There are some that I've seen where they're actually buying down the basis of the land because it's effectively providing funding that can help offset the cost of land value, which has gotten quite expensive in some markets. So it's a great strategy. I think what I would say, and no one really knows how it will shake out, is ultimately property tax revenue is a huge coffer to help fund all sorts of services in lots of places. It's one of the largest, I believe. And so with that in mind, it's a strategy that's really effective to support housing and making deals work. But it's one where it may not be available in every place at every moment. And that's something that we, just have to be cognizant of. But it can be quite effective. And there are some places where you are actually handicapping income. There are some places where it's more of a prospective approach to get ahead of the upward pressure on rents over time. And I'll just say briefly on the agency point, I'm sure others may have more to add. The agencies for many years have been huge proponents of this space. They have a duty to serve in their loan volume that they, execute upon every year, where they need to have a certain amount that's targeting the low and moderate income demographic, which is sort of generally in the zone of what we're talking about with NOAA. And so we've seen them over the years come up with a suite of products that look at workforce housing, that look at naturally occurring affordable housing or sponsored initiated affordability. So it's certainly one of the primary liquidity sources for debt financing for this space today.
Yeah, I think that this is a part of the business too that's just going to keep on expanding because of the supply demand imbalance that we've all referenced to. I think those of us that have an affordable housing background also have a real big advantage in this space because it's a different language to speak some of the, just the AMI, but more importantly, like how to operate these properties and how to do the tenant income certifications, how to do if there's a lottery system for some places, to double check the work of whomever's doing those certifications. So to get the abatement, it's not just like you show up and get it. There are requirements from the sponsor, even if it is regulation light and compliance light. So as this kind of mends with the affordable housing space as well, Noah, those that understand and speak both languages, like everyone on the panel, I think we're going to have big advantages because we understand it. A lot of market rate players are trying to get in this space because it can help deals pencil, potentially, but I don't think they fully understand the ramifications of what they're signing up for. And I just came home from a conference today where people were asking about the programs because they don't really understand them. And they're just trying to make deals pencil. And the agencies will sniff some of that out too if the sponsors aren't really committed to the space. But the agencies are on board with it. To Alicia's point, they're quite supportive of it because it does help them to meet their missions for affordability, and it is deeded. It's not just the sponsor initiated ones. It's much more. It's much more compliant.
Are you working hand in hand with capital A affordable developers too? Like, how is it? Are you guys working in conjunction? 'Cause you guys are.
No, I personally I could say that we're not. But in this space, the understanding the requirements of the 10 income certifications and understanding where the rent should be and how to identify the right property so you can achieve your underwritten returns and your requirements to your investors, but also be able to keep rents within the guidelines. Like not every property qualifies, and you have to really understand how you can do your renovations and still stay within the mandates for both the lender and the community in the regulatory agreement, and to be a good steward for the community. So not every deal pencils. So that's half of our challenge is probably finding those, because it's not every property.
Yeah, and I would just add to that, the way public policy often works is we're not reinventing the wheel. The language sometimes will be verbatim copy paste from another program in a very specific jurisdiction. So to Ty's point, I'm biased. I'm a huge advocate for professionals in the affordable space because that's the only part of real estate that I know. But at the same time, there's a sort of abstracting capability that we will have because if you've seen it in Texas, you recognize some of the features in other places or some of the priorities so that you can speak that language to the public jurisdictions overall. I think that's really important. And I think we don't necessarily partner with regulated capital A developers, but many of them are selling deals today, or some of their deals have traded. So you do need the LURAs, to Ty's point, the deed restrictions or the LURAs, they transfer to a next buyer. So you have the benefit for an investor, let's say, is that they know someone that has that as part of their skill set. If they sell those deals that have a tax abatement with a restriction, the next buyer has to honor the affordability program when it's under their ownership. So that, oftentimes many of us, we don't necessarily control, we can make best efforts how a deal is programmed after we sell it over our 10 or 15 years of ownership. But with these types of strategies, you do have the benefit, if it's long enough, of knowing that has to be maintained. But there's a skill set on the management side, on the structuring side, that comes with being able to negotiate these deals, structure them, and then manage and operate them effectively long term.
And also those exit caps tend to be higher.
Mm-hmm.
Yeah, we're crafting some of these too with municipalities. Like we're trying to create a program right now in a big city right now to create one of these programs for them, kind of adapting the language that Alicia mentioned for other states and trying to introduce it there. They're quite receptive.
Yeah, and I would just add, I think as many challenges as we see on the operational side, there's also a little bit of challenges in working with some of the local municipalities just because they are sort of used to operating in a capital A affordable space. And as much as they want to expand these programs to be a little bit more flexible, sort of bring more people under the tent, sometimes the actual application is not as smooth, and nothing kills a deal faster than time. And so it's also working closely with municipalities in advance of trying to get a deal done, to make sure that what we're underwriting is actually going to happen. It's going to happen in the time frame in which we need it, and just to facilitate a smooth closing process, in addition to then managing it.
Great question that I think would be good for wrap up. Unless Chris, did you have a wrap up? Or?
Go ahead. Last question. Go.
Well, Lisa, we've kind of talked about this, but extended use periods expiring and conversion of light tech properties to NOAA or market rate conversion to NOAA. And an anonymous attendee asked, what advice would you give a more traditional affordable housing developer that is thinking of expanding into NOAA? So I don't know if anyone wants to kind of hit on that as a wrap up. Or
So I'll just say this. I'll say that, historically, NOAA providers and our owner operators, rather, and more traditional capital A groups haven't necessarily always worked together. And I think there's a real benefit to, really trying to cross-pollinate and engage. And so if there is a thought to expand into the NOAA space, I think really finding opportunities, whether it's partnering directly or really engaging with more of the conventional owner operators, is really helpful because it is a different landscape. Many of us are not developers. We may partner on development deals, but we are more in the sort of day-to-day of operating a market business plan where we have to do a lot of the affordability programming directly. And so that would be my first bit of advice, is that they're just not the same exactly. So making that transition, we really benefit when we look at regulated deals when they come up by, looking at them side by side with groups that really understand that space. And I think the management piece is really like where there can be a huge gap. And so that's an area where understanding it's a different population and you have to manage and market to them differently.
Yeah, marketing, I would say. It's the difference between leasing and knowing what your comp set is. Like if you build it, it's not like affordable that they will come. They will not always be 99% occupied, as Dylan's point from earlier. You are competing with new product too in a lot of these markets, so you have to adjust your rents almost on a daily basis. And you really have to stay on top of the occupancy because it can dip quite quickly. So it's a different game. That's why one of the reasons I think a lot of us like it, because it's a combination between the affordable space and the market rate. That's one of the reasons that I love what we do.
The upside is your capital stack is likely to be a lot less complicated.
I was just thinking that. It's going to be a fraction of the number.
Your legal fees will be a lot lower.
All right, Kristen.
Thank you for listening to Beyond the Resume, a Jackson Lucas podcast where we take a deep dive into the career journeys of some of the top minds in real estate and equip you with the knowledge to move forward in your path towards the success you've envisioned. Make sure to like, share, and subscribe to Beyond the Resume. We're grateful for your support. All episodes of Beyond the Resume are brought to you by Jackson Lucas, building inclusive and diverse businesses through talent acquisition. Visit us at jacksonlucas.com.